I've summed up my 5 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. Please share with me your opinion about this book in the comments below. The Little Book That Still Beats the Market is a concise guide to a powerful investment strategy based on the fundamentals of the stock market. Written by Joel Greenblatt, a successful investor and founder of hedge fund firm Gotham Capital, the book provides a simple yet effective formula for beating the market. The book opens with an explanation of the magic formula, which is derived from 2 key financial metrics: return on capital and earnings yield. Greenblatt argues that by investing in companies with high returns on capital and low earnings yields, investors can identify undervalued stocks that are likely to outperform the market over time. Greenblatt stresses the importance of taking a long-term perspective when investing, focusing on the quality and price of companies rather than short-term market fluctuations. He critiques common investment strategies such as market timing, stock picking, and diversification, arguing that they are often ineffective and can lead to poor investment performance. Throughout the book, Greenblatt provides practical advice for implementing his investment strategy, including how to screen for stocks using the magic formula, how to manage risk, and how to avoid common pitfalls. He also shares insights into his own investment philosophy and approach. Overall, The Little Book That Still Beats the Market is a valuable resource for novice and experienced investors alike, offering a straightforward approach to investing that is based on fundamental principles and has been proven successful over time. The first main point of The Little Book That Still Beats the Market is the introduction of the magic formula, which is the centerpiece of the book's investment strategy. Greenblatt argues that investors should focus on buying high-quality companies that are valued lower than they should be based on their financial performance. The magic formula is based on 2 factors: return on capital, ROC, and earnings yield, EY. Return on capital is a measure of the profitability of a company and is calculated by dividing earnings before interest and taxes, EBIT, by tangible capital employed, TCE. Earnings yield is a measure of the earnings generated by a company relative to its price and is calculated by dividing EBIT by enterprise value, EV. Greenblatt's magic formula ranks companies based on their ROC and EY, then selects the top 30 stocks with the highest combined rank. These stocks are then held for 1 year before being re-ranked based on the same criteria, and the process is repeated. The magic formula is designed to identify companies that are both profitable and undervalued, with the aim of generating higher returns than the overall market. Greenblatt's backtesting of the formula shows that it consistently outperformed the market over a 17-year period, with an average annual return of 30.8% compared to the S&P 500's average return of 12.4%. While the magic formula is a simple and straightforward way to identify potentially undervalued stocks, it is not a foolproof investment strategy. Greenblatt acknowledges that there is no guarantee that the formula will continue to work in the future, and that investors need to be prepared for the possibility of underperformance or losses. However, by focusing on high-quality companies that are valued less than they should be, Greenblatt's strategy provides a solid foundation for investors looking to beat the market over time. The second main point of The Little Book That Still Beats the Market is the importance of quality and price when selecting stocks. Greenblatt emphasizes the need for investors to focus on investing in high-quality companies that are trading at a lower price than their intrinsic value. Greenblatt argues that high-quality companies tend to outperform low-quality companies over time. He defines quality as a company's ability to generate high returns on capital and has a sustainable competitive advantage. Companies with a history of high returns on capital are more likely to continue generating strong profits in the future, making them more attractive to investors. In addition to quality, Greenblatt stresses the importance of price when selecting stocks. He believes that investors should only invest in stocks that are trading at a lower price than their intrinsic value. This is because undervalued stocks have room to appreciate in value, providing an opportunity for investors to profit from the stock's future growth. According to Greenblatt, the combination of quality and price is critical to successful stock investing. He recommends looking for companies with high returns on capital and low earnings yields, as these companies are often undervalued by the market and have a higher chance of outperforming over time. By focusing on quality and price, Greenblatt's investment strategy encourages investors to look beyond short-term market fluctuations and instead focus on the long-term fundamentals of the companies they invest in. This approach allows investors to identify high-quality companies that are likely to perform well over time, providing a solid foundation for achieving long-term investment success. The third main point of the little book that still beats the market is the critique of common investment strategies such as market timing, stock picking, and diversification. Greenblatt argues that many investors focus on short-term market trends, attempting to time the market and pick individual stocks based on their perceived potential for short-term gains. However, this approach often leads to underperformance, as it is extremely difficult to time the market successfully and beat the average return of the overall market over time. Furthermore, Greenblatt argues that diversification can be overrated as a strategy for reducing risk. While diversifying your portfolio can help to minimize the risk associated with individual stocks, it may also lead to missed opportunities for higher returns. Rather than spreading your investments across many different companies, Greenblatt recommends focusing on a small number of high-quality stocks that are priced lower than their intrinsic value. Greenblatt suggests that an effective investment strategy relies on identifying high-quality companies that are trading at a lower price than their intrinsic value, a strategy that he has proven successful with his magic formula. The magic formula encourages investors to focus on the fundamentals of companies, such as return on capital and earnings yield, rather than short-term market trends. Overall, Greenblatt argues that many common investment strategies do not provide a solid foundation for achieving long-term investment success. Rather than trying to time the market or pick individual stocks based on short-term trends, investors should focus on identifying high-quality companies that are priced lower than their intrinsic value. This approach provides a solid foundation for achieving long-term investment success. Investors should focus on the long-term fundamentals of the companies they invest in, rather than getting caught up in short-term market fluctuations. He points out that the stock market can be unpredictable in the short term, but over the long term, it tends to reflect the overall health of the economy and the companies that make up the market. Furthermore, Greenblatt suggests that investors should avoid the temptation to try to time the market or jump in and out of investments based on short-term market trends. Instead, he recommends developing a long-term investment strategy based on a solid understanding of the fundamentals of stocks and the market. By taking a long-term perspective, investors can avoid the stress and uncertainty of short-term market fluctuations and focus on the underlying strengths of the companies they invest in. This approach allows investors to ride out short-term market turbulence and benefit from the long-term growth potential of their investments. Greenblatt cites several examples of successful investors who have taken a long-term perspective, including Warren Buffett and Benjamin Graham. These investors have built their fortunes by focusing on the long-term fundamentals of companies and avoiding the temptation to make short-term trades or market predictions. Overall, the little book that still beats the market emphasizes the importance of taking a long-term perspective when investing. By focusing on the underlying fundamentals of companies and riding out short-term market fluctuations, investors can build a solid foundation for long-term investment success. The fifth main point of the little book that still beats the market is providing practical advice for investors. Greenblatt offers insights into his own investment philosophy and approach and provides actionable advice for investors looking to implement his magic formula. One practical piece of advice that Greenblatt offers is to use a stock screener to identify potential investments based on the magic formula. This can help investors quickly identify high-quality, undervalued stocks that meet the criteria of the formula. Another piece of advice Greenblatt offers is to focus on managing risk. Investing always involves risks, and no strategy can guarantee success. However, Greenblatt suggests ways to minimize risk, such as avoiding highly volatile stocks and diversifying investments across different industries. Greenblatt also warns against common pitfalls that many investors fall into, such as getting caught up in short-term market fluctuations or investing in individual stocks without a solid understanding of their underlying fundamentals. Finally, Greenblatt emphasizes the importance of committing to a long-term investment strategy and avoiding the temptation to make short-term trades or predictions. By focusing on the long-term potential of high-quality, undervalued stocks, investors can build a solid foundation for long-term investment success. Overall, the little book that still beats the market provides practical, actionable advice for investors looking to implement Greenblatt's magic formula and build a successful investment strategy. By focusing on quality, price, and a long-term perspective, investors can minimize risk and maximize returns over the long term. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.